Hello, in this video, we'll be going through product warranty contingencies. Let's define what a loss contingency is first before we get into product warranties. A loss contingency is a potential loss that is dependent on a future event. And there's a whole other video just for loss contingencies that goes through it in much detail, but I'll just go through some of the highlights here. And a contingency is accrued and reported, which means it's recorded based on the likelihood that the event will actually occur, and the amount that is recorded will determine based on if the loss can actually be if it's known or unknown. And so for US GAAP purposes, a company is required to record a loss contingency based on if the event is probable, reasonably possible, or has a remote chance of occurring. Again, if you're not familiar with these terms, please go back and look at the contingencies video. Product warranties and guarantees are one type of loss contingencies. And warranties and guarantees, think of most big purchase items that you make, such as a car or a computer, are usually have a product warranty or a product guarantee. So let's just think about a car that you buy for $30,000 and has a 4-year or 48,000 mile product warranty. So that's kind of what we're talking about. And the question is, how much would we record for that warranty, potential warranty liability that we're going to have in the future if it hasn't actually occurred yet? So let's think about the car that comes with a 4-year, 48,000 mile warranty. When you buy the car, the company will record revenue for $30,000 because that's what they earned with a car. Attached to that car is the product warranty. And we know as a car dealer that some percentage of those cars will come back for some problems, some maintenance, oil changes, transmission problems, whatever it is. So what we have to do is the cost of satisfying the guarantees or the warranties should be estimated and recorded as expenses in the same accounting period as the products are sold. So if I sell a car in 2028 for $30,000, in that year 2028, I need to also record a warranty liability of some sort in the same accounting period. So the criteria for accruing a contingent loss for product warranties is almost always probable. And so although we can't predict what the liability will be, we can predict reasonably accurate estimates for the total liability for the period, and that's what we need to record. Caldor Health, a supplier of in-home healthcare products, introduced a new therapeutic chair carrying a 2-year warranty against defects. Estimates based on industry experience indicate warranty costs of 3% of sales during the first 12 months and 4% of sales during the next and 4% the next 12 months. During December 2027, its first month of availability, Caldor sold $2 million of chairs. During 2028, costs of $61,000 were incurred to satisfy the warranty claims. So when you have a product guarantee, which means that or product warranty, I should say, means that the warranty is the product you are purchasing comes with that warranty. You do not have to buy that warranty in addition to the product. It's all a manufacturer's warranty. So when that happens, in the year that we sell the product is the same year or the same accounting period that we need to record the warranty, the potential warranty liability. So if we sold here during December 2027, 2 million chairs were sold. So we debit cash or accounts receivable for 2 million, and we have revenue for $2 million. In the same accounting period, for the year end December 31, 2027, we must record the warranty liability associated with those products. And so the problem tells us that we expect 3% of total sales to be come back under warranty in the first year and 4% in the following year. So 7% total of 2 million is $140,000. So we're going to debit warranty expense in that same period we sold those chairs and credit warranty liabilities for 140,000. The problem goes on to say when customer claims are made and costs are incurred to satisfy those claims, the liability is reduced. Oh, sorry. They made claims of $61,000 in 2028. So when those claims are made, that's when we have to reduce our liability. So in 2028, when the warranty claims are made and satisfied, we're going to debit warranty liability for $61,000. And here we have credit cash, right? And so if we had to pay out some money to the customer, then we're going to credit cash. If we had to just replace some parts in the computer, let's just say, or the car, then we're going to credit parts and supplies. If we're providing a service and it just doesn't require any parts, it just requires, let's just say there's a TV and we had to have someone come out and fix the TV as part of the product warranty, we would credit salaries payable for the person the labor that's involved in that. So that's why it has these different accounts here and under the credit portion of this entry. Now, the traditional way of measuring the warranty obligation, or this is the same thing as warranty liability, is to report the best estimate of future cash flows. Okay, this is what we just did in the previous example. However, this ignores the time value of money. And we have learned in previous chapters that any liability that extends beyond 1 year, you must account for the time value of money and present value that cost. So present value that liability. So there's this thing called the expected cash flow approach for recording warranty liabilities. But it incorporates some probabilities of cash flows into the analysis. So you can only record the expected cash flow approach if the warranty expands more than 1 year, and we can estimate the probabilities of cash flow outcomes. And we're going to go through an example. Caldor Health, a supplier of in-home healthcare products, introduced a new therapeutic chair carrying a 2-year warranty against defects. It's the same example. During December 2027, Caldor sold $2 million of the chairs. Industry experience indicates that the following probability distribution for the potential warranty costs are as follows. So they think that in 2028, the chances of having to pay $50,000 worth of warranty costs there's a 20% chance. $60,000 there's a 50% chance, and so on and so forth. And then the following year, in 2029, because this is a 2-year product warranty, they say there's a 20% chance that our warranty costs will be $70,000, 50% chance that'll be $80,000, and so on and so forth. It further goes on to tell us an arrangement with a service firm requires the cost for the 2-year warranty period be settled at the end of 2028 and 2029, and the risk-free interest rate is 5%. So here's how this calculation, the expected cash flow approach, is done. For 2028 and 2029, we say, okay, we look at our probability of the warranty cost. We think there's a 20% chance that we'll pay out $50,000 of warranty costs in 2028. So we just use that probability chart, right? And we take the 50,000 times 20% equals 10,000. We think there's a 50% chance we'll have to pay out 60,000, which is 30,000, and then 30% for 70,000. So we add all those up and we get $61,000. Now what we do with that is we have to present value that back. Because this is a long-term obligation spanning more than 1 year, we're going to present value that back using our present value of a dollar table. If you're not familiar with how to use the present value, the time value of money tables, you should go back and look at previous videos where it goes into depth with different types of tables. Now, we made these sales in 2027, right? And it's going to go to 2028. There's a 2-year product warranty, 2029. So when we do our present value for 2028, we're just bringing back 1 period. So we're going to use the present value of n equals 1, the number of periods 1, and the interest rate is 5, which gives us 0.95238. So we take our 61,000 times that number, gives us 58,095. For 2029, right? The n equals 2. The number of periods that we're present valuing is 2 years. So because I'm going to go 1 and 2. Okay, so that's why for 2029, n equals 2 when you're using the present value of a dollar table. And that gives us 0.90703. And we take the probabilities right here and multiply them out and add them all together. And so our 2029 product liability under this expected cash flow approach is 73,000. I take my 58,000 here, my 73,000 here, and I get $131,564,000. And that's what we're going to record as our warranty liability at 12/31 when we sold those chairs, because when we have a product warranty, we're going to record the warranty expense and liability associated with it in the same period that we record the sale. So we're going to debit warranty expense for $131,564 and credit warranty liability for $131,564. Now we're going to talk about extended warranty contracts. So extended warranty contracts are warranties that go beyond the manufacturer's original warranty. So in my car example, if you buy a car for $30,000 with a 4-year, 48,000-mile manufacturing warranty, that comes with the cost of the car of $30,000. Many times when you go buy a car, they'll say, oh, well, you can buy an extended warranty that goes beyond that timeline. So you could buy an additional 3-year, 36,000-mile extended warranty that you would have to pay in addition to the $30,000 for the car. So that's what we're talking about here when we're talking about extended warranty versus, don't get it confused with product warranty. So the extended warranty is priced and sold separately from the warranted product. And by doing that, because it's separate from the actual product, a separate performance obligation has occurred, and you need to have a performance obligation in order to recognize revenue. And so that extended warranty, we get the cash. Let's just say you buy that extended warranty for the car and it's for 3 years. That is a type of a deferred revenue, right? Because we're collecting the cash in advance, and I would debit cash for however much and record a deferred revenue. Now, with extended warranties, you record the deferred revenue at the time of the sale, and then you recognize that revenue into the income statement over the contract period using a straight line basis. Let's go through an example. Brand Name Appliances sells major appliances that carry a 1-year manufacturer's warranty. Okay, so if we had the information for the 1-year manufacturer's warranty, we would record the warranty expense and warranty liability in the same period that we record the sale of the appliances. Customers are offered the opportunity to, at the time of purchase, to also buy a 3-year extended warranty for an additional charge. On January 3rd, 2027, brand name sold a $60 extended warranty that covers the years 2028, 29, and 2030. So it covers 3 years. So on January, whatever these appliances are, we are going to debit cash or accounts receivable and credit sales revenue, right, for the appliances. In a separate journal entry for the extended warranty, we would, at the time of sale of the products on January 3rd, 2027, we would debit cash or accounts receivable for the $60 and credit deferred revenue extended warranty. And remember, deferred revenue is a liability. And it's a liability because we've received the $60 and now we might owe you, right, a service for this extended warranty or parts for the extended warranty. As time goes on, right, because this warranty is for 3 years, at the end of each of the following 3 years, in December 31, 28, 29, and 30, we are going to reduce our liability for 1/3 of the total liability. So we're going to debit deferred revenue extended warranties by $20 each year, each of those years, and we're going to recognize revenue of $20 for each of those years. Concept check. On October 1, 2027, Mahur Inc. sold a $480 snowblower with a $120 extended warranty. The warranty covers 3 years of repairs, and during 2027, Mahur would recognize warranty revenue of how much? Well, just even though the problem doesn't ask for it, on October 1, we would debit cash or accounts receivable for the sale of the snowblower for $480. So and then credit revenue goes on our income statement for $480. Okay. At the same time, on 10/1, we would also record this $120 extended warranty. So we're going to debit cash for this $120 and we're going to credit a deferred revenue. That's a liability for $120. So we would book both of these entries. And the question asked during 2027, how much warranty revenue would the company record? So this revenue up here, that's just the regular revenue. It's talking about the second part. How much revenue at the end of the year would we recognize from this extended warranty? And the warranty is for 3 years, and we need to figure out for 12/31/27. So I'm going to take 120 divided by 36 months, which is 3 years, and then I need to do that for, which equals, let's just see, equals $3.33 per month, right? That's how much revenue I can recognize each month as each month goes on. And I have to figure out for 12/31/27, well, that gives me the month of October, November, and December. So that's 3 months. So multiply that by 3, and I get $10. So on 12/31/2027, I'm going to debit my deferred revenue, my liability, for $10, and then I'm going to credit my warranty revenue. Warranty revenue, $10. So the answer is going to be $10. You see how it gives you $3.33? That's just for 1 month. You have to multiply that for the 3 months. And there we go.